Hi, my name is Herman. I'm a software engineer in practice. I have a question for Keith because you talk about fixed securities, which is something I looked at recently as well. As we all know, at a high level, this is towards the end of the interest rate hike cycle. So most of the damage has already done. The returns becomes very attractive at this point. But on the other hand, the credit risk is also elevated because, so usually companies that issue debt, they have to roll over their debt. And at this point, they have to roll over their low interest rate debt to high level debt. And some poster child is like office properties, some commercial real estate, right? Even Charlie Munger doesn't like those properties, right? Just wonder what your thought about this.
Well, I think this is where good underwriting really comes to the fore here, because in essence, the duration risk or the duration stress is played out right now. But what's going to be playing out going forward is the actual underwriting. And so that's why I think if you focus on the people that have good underwriting process and do good underwriting going forward, you'd mention like the office, compare like office to multifamily, right? Part of the issue with office is some of these buildings aren't going to have any cash flow, so you have to restructure. Multifamily still going to have an amount of cash flow, and so maybe they can make it through it. But I think at this point in the cycle, one thing to really look at is look at the banks and also the, let's say, BDCs or other credit providers that have a really good underwriting record, because what's really happened is these short-term interest rates have created a very nice spreads and very nice rates of return on the debt, but you just got to make sure that you're not going to default on the debt, right? I mean, because you get all this floating rate debt, you get these really nice interest rates, but it doesn't make any difference if they default on it. It's still not going to be an issue. But that's what I'd sort of encourage, and that's what I try to look at in some of these BDCs, the ones that are the best, that have the best underwriting, and the same thing for the banks. I mean, an interesting situation now is there's a company called Hingham who has great underwriting sort of historical profitability, but their NIMs are getting squeezed because of this duration thing. And I think it's an interesting opportunity now for that type of thing if you can, because the downside on something like that is if interest rates, for whatever reason, continue to go up, their NIMs are going to get smaller and smaller and smaller. And, and how much of it. The interesting thing about Hingham, though, is that it's not necessarily obvious is that their loans are turning over at 16% per quarter. So this is a temporary thing for those kind of guys. But those are the types of things I think if you dive into it, you need to really dive into it and sort of see those types of factors that can say, okay, for me, that gives me a lot of confidence, because that means that these things are all going to reset within the next 12 to 18 months, and the NIMs should expand back out. But if you have a situation where the NIMs are getting smaller and smaller and smaller, I mean, that's sort of, in essence, what happened to like First Republic and these other banks that have gone bankrupt. The deposits didn't go away, but the NIMs got so small, the banks become, even if it's alive, it's going to be a zombie bank because the NIMs are just not going to create any profit. But I don't know. It's a good, interesting question. I mean, I know Jeff does a lot of stuff with banks. What are your thoughts on these types?
No, I have nothing to add.
Maybe like Steve, do you look at this? Do you look at any like special situation opportunity from this kind of situation?
Sorry. Related to what? Sorry.
From this like high interest rate environment, these fixed securities.
Yeah, I haven't seen. I mean, I don't have anything that I've come across lately, but it's a theme. I agree to keep an eye on. I generally kind of stayed away from even getting too much into these different banks that might have any sort of contagion effect. I suppose even like Schwab and others like that. But you're looking for mispricing, so it's an area to look at.
Thank you very much.